In 2004, however, the SEC succumbed to a push from the big investment banks led by Goldman Sachs and its then chairman, Henry Paulson, and authorized investment banks to develop their own net capital requirements in accordance with standards published by the Basel Committee on Banking Supervision. This essentially involved complicated mathematical formulas that imposed no real limits and was voluntarily administered. With this new freedom, investment banks pushed borrowing ratios to as high as 40-1, as in the case of Merrill Lynch. This super leverage not only made the investment banks more vulnerable when the housing bubble popped, it enabled the banks to create a more tangled mess of derivative investments so that their individual failures or the potential of failure became systemic crises. Former SEC Chairman Chris Cox has acknowledged that the voluntary regulation was a complete failure. Then 6, bank self-regulation goes global, preparing to repeat the meltdown. In 1988, global bank regulators adopted a set of rules known as Basel I to impose a minimum global standard of capital adequacy for banks. Complicated financial maneuvering made it hard to determine compliance, however, which led to negotiations over a new set of regulations. Basel II, heavily influenced by the banks themselves, establishes varying capital reserve requirements based on subjective factors of agency ratings and the bank's own internal risk assessment models. The SEC experience with Basel II principles illustrates their fatal flaws. Commercial banks in the United States are supposed to be compliant with aspects of Basel II as of April 2008, but complications and intra-industry disputes have slowed implementation. Then 7, failure to prevent predatory lending. Even in the deregulatory environment, the banking regulators retained authority to crack down on predatory lending abuses. Such enforcement activity would have protected homeowners and lessened, though not prevented, the current financial crisis. But the regulators sat on their hands. The Federal Reserve took just 3 formal actions against subprime lenders from 2002 to 2007. The Office of Comptroller of the Currency, which has authority over almost 1,800 banks, took just 3 consumer protection enforcement actions from 2004 to 2008. Number 8, federal preemption of state consumer protection laws. When the states sought to fill the vacuum created by federal non-enforcement of consumer protection laws against predatory lenders, the feds jumped to stop them. In 2003, as Elliot Spitzer recounted, during the height of the predatory lending crisis, the Office of Comptroller of the Currency invoked a clause from the 1863 National Bank Act to issue formal opinions preempting all state predatory lending laws, thereby rendering them inoperative. The OCC also promulgated new rules that prevented states from enforcing any of their own consumer protection laws against national banks. 9. Escaping accountability, or assignee liability. Under existing federal law with only limited exceptions, only the original mortgage lender is liable for any predatory and illegal features of a mortgage, even if the mortgage is transferred to another party. This arrangement effectively immunized acquirers of the mortgage, assignees, for any problems with their initial loan and relieved them of any duty to investigate the terms of the loan. Wall Street interests could purchase, bundle, and securitize subprime loans, including many with pernicious predatory terms, without any fear of liability for illegal loan terms. The arrangement left victimized borrowers with no course of action against any but the original lender, and typically with no defenses against being foreclosed upon. Representative Bob Ney, a close friend of Wall Street, who subsequently went to prison in connection with the Abramoff scandal, was the leading opponent of a fair assignee liability regime. 10. Fannie and Freddie enter the subprime market. At the peak of the housing boom, Fannie Mae and Freddie Mac were dominant purchasers in the subprime secondary market. The government-sponsored enterprises were followers, not leaders. But they did end up taking on substantial subprime assets, at least $57 billion. The purchase of subprime assets was a break from prior practice, justified by theories of expanded access to home ownership for low-income families and rationalized by mathematical models allegedly able to identify and assess risk to newer levels of precision. In fact, the motivation was the for-profit nature of the institutions and their particular executive incentive schemes. Massive lobbying, especially including but not only of democratic friends of the institutions, enabled them to divert from their traditional exclusive focus on prime loans. Fannie and Freddie are not responsible for the financial crisis. They are responsible for their own demise and the resultant massive taxpayer liability. 11. Merger mania. The effective abandonment of antitrust and regulated principles over the last 2 decades has enabled a remarkable concentration in the banking sector, even in advance of recent moves to combine firms as a means to preserve the functioning of the financial system. The megabanks achieved too big to fail status. While this should have meant that they be treated as public utilities requiring heightened regulation and risk control, other deregulatory maneuvers, including repeal of Glass-Steagall, enabled these gigantic institutions to benefit from explicit and implicit federal guarantees, even as they pursued reckless, high-risk investments. And finally, 12, the rampant conflicts of interest, the credit ratings firms' failure. Credit ratings are a key in the financial crisis story. With Wall Street combining mortgage loans into pools of securitized assets and then slicing them up into tranches, the resultant financial instruments were attractive to many buyers because they promised high returns. But pension funds and other investors could only enter the game if the securities were highly rated. The credit rating firms enabled these investors to enter the game by attaching high ratings to securities that actually were high risk, as subsequent events have revealed. The credit ratings firms have a bias to offering favorable ratings to new instruments because of their complex relationships with issuers and their desire to maintain and obtain other business dealings with issuers. This institutional failure and conflict of interest might and should have been forestalled by the SEC, but the Credit Rating Agencies Reform Act of 2006 gave the SEC insufficient oversight authority. In fact, the SEC must give an approval rating to credit rating agencies if they are adhering to their own standards, even if the SEC knows those standards to be flawed. Well, there's only one conclusion that I can make to all that for you, ladies and gentlemen, which is what you need to know when you hear these ridiculous cries of insufficient regulation. We need more regulations. The regulations don't work. Why don't we have regulation? The regulations were all there. Ladies and gentlemen, if you don't know this, listen to this on the archives once more. Listen to how I have described in 12 steps how regulations were systematically disbanded and disregarded. And you will understand that the regulatory environment in 1990 was perfectly adequate to take care of all of these issues that I have described to you over the last 20 minutes. Never again need any of you be under any misapprehension that there were not enough regulations. But needless to say, all those responsible for disbanding and disregarding the regulations will have you believe that there weren't enough regulations. Why? Because they were the ones that disbanded the regulations and disregarded them, and they want to disguise their own errors of judgment and failures to regulate. So, of course, they're going to pull the wool over your eyes and throw a smoke screen over this and pretend that there weren't enough regulations. Now, ladies and gentlemen, you know for sure that there were indeed enough regulations. And that's why I feel it's important to emphasize this and have you hear this out, because otherwise, there is a risk that you will fall prey to these people and their revisionist history. Don't let it happen.